In May, I watched my balance gain over $2,000 and then climb past $13,000. I even saw days where my portfolio added $400 in value. Today, I'm going to share with you my top 3 performing companies, including which company in my portfolio gained over 100%, my bottom 3 performing companies, and what dividends I was paid. For those of you who don't know, 17 months ago, I set myself a challenge. The challenge was to reach $100,000 within 8 years. And I worked out that with just 14% gains annually, plus reinvesting all my dividends, it is possible. I also realised that I had an opportunity to document this challenge publicly so I can share my knowledge along the way and hopefully inspire others to invest in their futures also, because investing isn't taught in schools. If you want to grow alongside me and start your own investment journey, or simply see if I can complete this challenge, subscribe to the channel, click the little bell icon and get the notification when my next portfolio update is published. So in May, I saw my portfolio gain almost 14%, while the S&P 500 had gains of around 5%. The S&P 500 is used by many investors, independent retail investors like myself, and institutional hedge fund investors as a benchmark. But let's be clear here, 5% gains in a month is very good. Almost 14% gains is quite unbelievable, to be honest. I will tell you more about how this happened later in the video. Year to date, my portfolio is sitting at a very healthy 27%, which is more than double the S&P 500's year to date of around 10%. In third place, we have CVS. CVS gained almost 14%. And as you can see from the graph, they had a steady climb up through the month, but there's a slight pullback towards the end of the month. This gain likely happened because they beat their earnings forecast, 6.2% up year over year. It also seems that investors are quite happy with the CEO's restructuring and strategy. In second place, we have IBM. IBM gained almost 28%. As you can see from the graph here, there was a sharp peak at the beginning of the last quarter of this month, and it slowed down slightly but then continued to gain momentum. This likely happened because they also beat their earnings forecasts, 9% year-over-year revenue growth, as well as securing a $1 billion award under CHIPS and Science Act to build a domestic quantum foundry, which would be dedicated to manufacturing quantum-grade superconducting wafers. And in first place, we had Dell. Dell gained a whopping 103%. And as you can see from the graph, I took a screenshot of the last week in May instead of the full month, but you can still see the massive 66% gain in that week. Absolutely crazy numbers. But why did this happen? Explosive AI server demand. AI optimized servers soared by 757% year over year. Massive beat and raise earnings, up 88% year over year, absolutely crashing analyst estimates by over 8 billion. A huge backlog and order pipeline, proving that the AI boom isn't slowing down, with reports of 24.4 billion in new AI orders, 9.7 billion defense contract, organizing and combining all of the military's scattered Microsoft software, cloud accounts, and computer systems into one central setup. However, this huge success creates new challenges. Because Dell's price skyrocketed, its dividend yield has plummeted, and my portfolio dividend yield is dropping, which threatens my target of a 3.5 yield. So what shall I do? Even though the dividend yield is dropping, the actual payment I receive is stayed the same. But by the time I'm reaching $100,000 portfolio balance, the benefit of having a 3.5% dividend yield means I only need to contribute half of what I do now monthly, The reinvested dividends will do the rest of the work. I need to have a think. Would adding an all-world ETF with a more stable 2.5 to 3% dividend yield into my portfolio, and then dollar cost averaging into it each month, which would then account for around 10% of my total portfolio? Would this strategy give me the dividend yield stability that I'm looking for? I will need to make some calculations and do a bit of research. Make sure you tune in to the next month's portfolio update and find out what I decided to do. In third from the bottom, we have Mastercard. Mastercard saw a drop of around 4.5%. And as you can see from the graph, yes, I took the wrong screenshot again. And this is what happens when I'm trying to do something new and I'm trying to show you more than just numbers on the screen. But anyway, you can see that the steady decline wasn't due to a fundamentally broken business. In the first quarter, they beat their earnings forecast. This decline is likely to do with a combination of regulatory headwinds, macroeconomic worries, and a temporary travel bottlenecks. Second from the bottom, we have Omnicom Group. Omnicom Group saw a decline of around 5.5%. And looking at the graph, you can see bigger daily swings compared to the other companies that we've looked at today. For me, it looks like investors were unsure, because even with the strong top line revenue growth and the merger with Interpublic Group, it's missed earnings that Wall Street estimates. But more importantly, to fund the merger, they had to increase the outstanding share count by 46% year over year, causing a shareholder dilution. And at the very bottom, we have Pepsi. Pepsi had around 7.5% decline. And when you see the graph, you can see a couple of sharp drops there and an overall steady decline. This could be mirroring the low consumer confidence and price sensitivity, possibly due to Pepsi's recent price increases. But let's not forget, due to the high momentum in tech stocks, money has naturally rotated out of defense consumer staples like Pepsi to chase the high momentum tech growth. In my opinion, I'm not worried about these declines. The companies are still solid and it's normal to see these macroeconomic changes. My strategy is to hold good quality growth and defensive stocks. I use my own intrinsic value calculator to understand what stock is best valued for my portfolio to add the monthly contribution to. This strategy generally means I don't need to rebalance my portfolio every year, but I do need to be aware of bigger rises like Dell that could start tipping my portfolio. So 10 companies sent me a slice of their profits this month, totaling $17.18. And even though we saw massive gains from Dell's share price this month, these dividends remained the bedrock of my strategy. CVS, AbbVie, and Dell were the big hitters this month. But all my dividends continue to provide a consistent, passive cash flow that keeps me motivated during the rocky months. My monthly contribution, as well as my reinvested dividends, came to $557 this month. And as usual, I put 5% of the contribution to my gold ETF and 5% to my Bitcoin. 9 companies were picked out by my intrinsic value calculator this month. It worked out at roughly $55 per share. So we finished May at $13,176. A month ago, I was celebrating getting past the $11,000. Now the momentum is compounding. If we take that 14% annual gains we need to complete this $100,000 challenge on time, my end of year target is $14,215. But if we adjust last year's 14% target to the 27% that we actually got, our adjusted target for this year is $16,236. At this point in time, I feel this is very achievable. We could even hit $20,000 by the end of the year. I don't know about you, but I'm feeling the excitement. We are now hunting down $15,000 and then hopefully soon $20,000. Don't forget to follow along, subscribe and hit that little bell. If you're interested in starting your own investing journey, check out my beginners playlist. There's videos there that might answer some of the questions for you. And you can always watch how I started with just over $1,000 17 months ago, and you can see how I got where I am today in the Portfolio Updates playlist. If you do have a question, please leave it in the comments. I hope you found this video helpful. I've been Steve Williams and I'm the Dividend Dad. See you soon.